This is Quent Bilo with a continuation of budgetary planning. In this talk, I want to explain the principal sections of a cash budget, which is part of the financial budget. Only after operating budgets have been completed can financial budgets be prepared. There's lots of cash flows that are inherited from the operating budgets, such as when purchases are paid for, sales are collected, etc. There's our perspective, part of the financial budget. Cash budgeting is informed by capital expenditures and the operating budgets. One of the major functions of corporate finance is to anticipate the needs for funds in the company. The cash budget is a financial budget prepared to calculate the budgeted cash inflows and outflows during a period and the budgeted cash balance at the end of the period. The cash budget helps managers determine any excess, idle cash, or cash shortage that is expected during a period. Such information helps managers to plan accordingly. There are three broad categories in the cash budget: cash receipts, disbursements, and financing. All businesses need to maintain a safe level of cash to enable them to carry on business activities. The managers of business need to determine that safe level. The cash budget is then prepared by taking into account that safe level of desired cash balances. So if a cash shortage is expected during a period of time, a plan to borrow can be made. So beginning and desired ending cash balances are key. Here's a high-level summary format of a cash budget. The cash budget is a component of the master budget and is based on the following components of the master budget: schedule of expected cash collections, both from cash sales, credit sales, schedule of expected payments for the factors of production, materials, labor, and overhead, and also selling administrative expense budgets, tax payments, special capital spending needs, etc. A cash budget essentially maps out these cash flows and indicates the period in which they will occur. Cash budgeting at its core is a straightforward procedure that simulates cash flowing through a company. If we can accurately estimate the amounts and the timing of these cash flows, then we can also estimate whether the company will experience a shortage of cash or excess of cash during a given month. So the financing component, whether borrowings are needed or repayments of debt, are the key question that the cash budget responds to. Here's an alternative format of the cash budget. Same information, just putting the borrowing or the possible repayments at the bottom. Again, that's the final question that's answered by a cash budget. Will money be required to be borrowed during a period of time, or can there be possible repayments of previous debt? It's all premised on the amount of cash expected to come in and the desired ending cash balance that's required by the company. The cash receipts section of the budget are expected receipts from the principal sources of revenue, such as cash sales or the timing of credit sales and their collection. Also, any expected interest or dividend receipts are factored in. Proceeds from the sale of investments, plant assets, sale of capital stock, for example, all cash receipts. The cash disbursement section are expected cash payments for direct materials, direct labor, overhead, and selling administrative expenses, and also capital spending needs. The financing section that determines, in combination with the desired ending cash balance, whether borrowings are needed or repayments of borrowed funds can occur during a particular period. The cash budget must be prepared in sequence. The The ending cash balance of one period is the beginning cash balance for the next. Data is obtained from other budgets, such as the operating budget, and management's expectation as to the timings of cash flows. They're often prepared on a monthly budget or quarterly. It does contribute to a more effective cash management. It shows managers the need for additional financing before the actual need arises, or indicates if excess cash will be available. Again, it all starts with data from the operating budget, combined with other forecasts such as capital spending budgets and other relevant expected actions affecting the cash balance. The cash budget is pieced together to determine if sufficient cash will be generated from operations to fund all plans, or whether borrowing may be needed. The following is a lengthy illustration for the Hayes Company. Various assumptions here. We start with a cash balance of $38,000, and Hayes wishes to maintain a balance of at least $15,000 at the end of each period. The periods here will be quarters. The beginning of the assumptions: sales. 60% are collected in the quarter sold, and 40% are collected in the following quarter. The beginning balance of accounts receivable of $60,000 will be collected in the first quarter of 2014, which is our budget year. Other assumptions: short-term investments will be sold in the first quarter. Direct material payments will be scheduled out, half of it paid in the quarter purchased, the other half in the following quarter. Direct labor will be paid in the quarter incurred. We have a schedule on that. And manufacturing overhead and other expenses are paid in the quarter in which they're incurred. A special capital spending need, a truck, will be paid for in the second quarter, $10,000 cash outflow. And the company will make equal quarterly payments of all its estimated annual income taxes. And loans will be repaid in the earliest quarter in which there's a sufficient cash on hand, that is, cash exceeding the minimum $15,000 required. We'll begin by preparing a schedule of collections from customers. So our collection from customers, incoming cash, first of all, the balance in accounts receivable at 12/31 of $60,000 is assumed to be collected in the first quarter of the next year, 2014. Our credit sales of $180,000, 60% are collected in the quarter of their occurrence. So $108,000 is collected in the first quarter of $180,000 of sales. Total of $168,000 incoming first quarter. Second quarter, first thing we'll collect is the remaining 40% of the first quarter sales in the following or second quarter. That is, $72,000 is collected, quarter two. The second quarter credit sales of $210,000, 60% of that is collected in that quarter, $126,000. Total cash received second quarter, $198,000. Third quarter, picking up on 40% of the second quarter's sales, $84,000, 40% of $210,000, collected in the third quarter. Third quarter sales of $240,000, 60% collected right away, $144,000 in that month. Total of $228,000 incoming from sales in the third quarter. Likewise, fourth quarter cash collections, picking up on 40% of the third quarter sales, $96,000 remaining, collected in the fourth quarter, plus 60% of the fourth quarter sales of $270,000 or $162,000 coming in the fourth quarter. Total cash coming in fourth quarter, $258,000. Simply scheduling out these collections by our timing assumptions. These collection results will be later transferred to a final schedule. Let's switch to cash payments for direct materials. First of all, we expected our payables balance at December 31st to be paid off in the first quarter, $10,006 outgoing. And for our total direct material purchases in the first quarter, $25,200, the assumption is that half of that, 50%, will be paid in the quarter that we committed those. That 50% will be paid in the quarter that the purchase is made, $12,600 in the first quarter outgoing. Total cash outflows for payment of direct materials, $23,200 in the first quarter. Second quarter, we pick up the other 50% of the first quarter purchases, $12,600, and we pay half of the second quarter purchase of $29,200, or $14,600 in that second quarter. Total outgoing, $27,200, second quarter. Third quarter picks up on the other 50% of the second quarter's purchases, $14,600, and half of the current month's purchases of $33,200, or $16,600 outgoing in the third quarter. Total outflow, $31,200 for direct materials purchases, third quarter. Fourth quarter picks up the remaining 50% of the third quarter purchases, $16,600 outgoing, plus 50% of the current purchases, $18,600 from the purchases of $37,200. Total cash outflow, fourth quarter for direct materials, $35,200. And again, the results of this schedule we transferred to a final schedule. Direct labor hours. This was in a previous talk. These are the calculated direct labor needs to support our production budget, $62,000 in the first quarter, etc. These are soon to be paid in the quarter incurred, as shown. This will be another one-line item on our final schedule, total direct labor payments. And here's our cash budget that's pieced together from all our previous schedules, combining inputs from the operating budget, capital expenditure budget, and others. So we start with our beginning cash balance of $38,000. In our previous collection from customers, we bring in $168,000 of collections in the first quarter, $198,000 in the second quarter, etc. Sales securities, assume that we'd sell our $2,000 short-term investment in the first quarter, cash coming in, subtotal that. So total available cash, first quarter, $208,000, beginning balance plus all receipts. We move to our second section, disbursements. And from our prior schedule of direct materials, we're bringing our $23,200 outgoing in first quarter, $27,200 in the second quarter, etc. Direct labor schedule, right from our previous listing of outgoing of $62,000, etc. Manufacturing overhead. These are all given data that we would disperse these expenses in the quarter incurred. Likewise, the purchase of our truck was incurred in the second quarter, $10,000 outgoing. And our income tax expense for the year of $12,000 was paid pro rata, 1/4 each quarter, or $3,000. We can subtotal our total disbursements for the first quarter, $182,500. Subtract that from our total available cash of $208,000. And so we forecast an excess of cash at the end of the first quarter of $25,500. That exceeds our minimum balance, therefore there is no need to borrow in that first quarter. However, the second quarter, we can see that when we add up our total disbursements of $211,500, subtracting them from our total available cash of $223,500, we have a forecast cash balance of only $12,000. Our assumption was the company needed a minimum of $15,000 at the end of each quarter, and therefore we have our borrowing action of $3,000 to achieve our desired minimum balance of $15,000 at the end of that second quarter. To emphasize, this is the key question a cash budget will answer. Is there a need in any particular time period to borrow money? Second quarter, yes. Adding down our total available cash in the third quarter, $243,000. Subtracting out our total expected disbursements of $220,500, we have a forecast cash available of $22,500. That exceeds our $15,000 minimum. Therefore, we can repay our previous borrowings plus interest, $3,100, come down to our forecast cash balance in the third quarter of $19,400. And again, the fourth quarter, same mathematics. Total available cash, $277,400. Subtract from total forecast disbursements of $239,500. We expect excess cash during the fourth quarter of $37,900. No need to borrow. It exceeds our minimum cash desired to have on hand. As you can see by the prior schedule, the cash budget brings many subschedules and their timing assumptions together. Assumptions on the collections of accounts receivable, assumptions on the payment of accounts payable, payment of labor, taxes, overhead, etc. All this is headed toward a forecast cash position at the end of each period, and whether borrowings may be needed to maintain a minimum balance or whether there is sufficient cash to allow repayment of loans. Here's a review question. Expected direct material purchases in Reed Company are $70,000 in the first quarter, $90,000 in the second quarter. Assume that 40% of the purchases are paid in cash as incurred and the balance in the following month. What's the budgeted cash payments for purchases in the second quarter? $78,000. Calculated as follows. The first component is $42,000, which are the balance of the purchases made in the previous quarter. That is, 60% of the $70,000 purchased in the first quarter are paid in the second quarter, and the $36,000 component is 40% of the current month's purchases of $90,000. Total of $78,000, second quarter forecast cash payment for purchases. Here's another example. The Martian Company wants to maintain a minimum monthly cash balance of $15,000. At the beginning of March, the cash balance is $16,500. Expected receipts for March are $210,000. Expected payments, $220,000. Question is, how much cash, if any, must be borrowed to maintain the desired monthly cash balance? So, starting with our beginning balance of $16,500, we add in our receipts for March, $210,000. Total available cash, $226,500. From that, we subtract our expected disbursements from March of $220,000. Come down to an excess available cash over disbursements of $6,500. The activity for the month plus the beginning balance. But we desire a $15,000 minimum balance, so our final decision is to borrow $8,500 in this quarter to maintain that minimum $15,000 cash balance. Again, the financing element is the last line to determine the cash budget for a particular period.